Hey everyone, welcome back to Corporate Decoder, the place where we dive into the confusing world of corporate filings. Today we are cracking open the FT Vest Annual Hedged Equity Income Fund. T's registration statement, trust me, this isn't just another pile of financial jargon. It's more like a treasure map, but instead of gold, we're hunting for, well, maybe just slightly less disappointing returns. This document, filed in May of 2025, is an initial registration statement for a new fund. It tells us about the fund's plans, how it will operate, and of course, all the potential dangers that lurk within its investment strategy. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and join our Discord community for extended breakdowns. Their fund aims to deliver a mix of high current income and limited long-term growth, while trying to protect against losing money. This is achieved by investing in US stocks from the S&P 500 index, buying protection against market declines, which they call a downside hedge, and trying to create income. One key part to remember is the fund is shooting for a net income objective of 9.0% each year. However, this isn't a guarantee. This defined income is where the fund sells covered calls on stocks that it holds. It is also important to realize that the reference index is a price return index and does not reflect the reinvestment of dividends. The fund operates in 1-year designated periods during which it buys the hedge. The hedge is intended to work fully at the end of the period, and if the fund were to change the target net income objective, they will let you know before the end of the period. This means it is very important to hold shares of this fund for an entire year to see the full benefit of their strategy. Now, let's look at some fees so you know what you will be paying. First, there is a sales charge, and Class A shares have 1.5% load added as a percentage of subscription. Class I shares don't have this. The unitary management fee is 2.65% annually for both shares based on the fund's net assets. Also, the distribution and servicing fee is 0.75% for Class A and 0.25% for Class A and 0.75% for Class A and 0.25% for Class I. Here's what that looks like in practice. Imagine you invest $1,000, assuming a 5% annual return in Class A shares. You would pay $44 in the first year. However, the Class I shares would only have $39 with Class I and $329 with Class I and $300 in expenses. After 10 years, it costs you $3 with Class A and $3 to $9 with Class I. The fund can also borrow money to increase its returns, known as leverage. They can only borrow up to 33.13% of its total assets in accordance with the Investment Company Act. Leverage can increase gains, but it also massively increases the risk of losses. Now we need to talk about some risks. The fund is brand new, which means they have no track record. You are betting on their plans and managers, not real performance. Shares are not easily sold. It's a closed-end fund. It does not intend to list the shares for trading on any securities exchange, and the fund does not expect any secondary market to develop for the shares. Shares are considerably less liquid than shares of funds that trade on a stock exchange. The Board of Trustees may determine not to conduct a tender offer, meaning shareholders may be unable to tender shares for repurchase. You could be stuck for the life of the fund. They note the investment value can increase or decrease in response to expected or perceived financial events. Recent conditions could potentially lead to adverse effects in response to lack of liquidity in the bond or equity markets or volatility. We've all seen how quickly things can change. The filing notes that further market conditions could lead to more government intervention. These interventions have sometimes been unclear and created confusion. They specifically highlight the ongoing uncertainty about trade policies, treaties, and tariffs. There is a risk that the fund may not raise capital sufficient to maintain profitability and meet its investment objective, and an inability to raise sufficient capital may adversely affect the fund's financial condition and liquidity. The timing of such liquidation may not be favorable and could have negative tax consequences for shareholders. As mentioned before, the fund uses derivatives. This can create larger gains, but it also means larger losses. The value of derivatives changes quickly and can be influenced by many factors. If the fund needs to sell quickly, it might not be able to get a good price. The fund is also subject to legal and regulatory changes. Tax rules around derivatives are complicated, and there could be changes that hurt the fund's returns or ability to operate. The fund is trying to work as a regulated investment company, which requires diversification of their assets and income to be distributed to investors. If they fail to do this, they can be taxed as a normal corporation, resulting in double taxation and lower returns. The success of the fund depends on the people picking the investments and the right weighting for the assets. Any loss or turnover of the sub-advisor's personnel responsible for making investment decisions may have a material adverse effect on the operations and performance of the fund. When the advisors anticipate unusual market or other conditions, the fund may invest all or a portion of its assets in cash or cash equivalents, or accept lower current income from short-term investments. In such a case, shareholders of the fund may be adversely affected and the fund may not pursue or achieve its investment objective. The investment advisor and sub-advisor manage other accounts, creating potential conflicts, including unequal attention, limited opportunities, and pricing benefits. The fund also has the inherent conflict of the fund being affiliates of the advisors, so none of the transactions among the investment advisor or any of its affiliates has been or will be negotiated or conducted on an arm's length basis. The fund is subject to risks arising from various operational factors, including human error, processing and communication errors, or the errors of third-party services. The fund relies on third parties for a range of services, including custody, so any delay or failure relating to service providers may affect the fund's ability to meet its investment objective. Cybersecurity risks are included because computer systems may be vulnerable to unauthorized access. If there is a cyber attack, could jeopardize confidential information. Because the fund is being offered as a private offering, it's required to take reasonable steps to verify investors' qualifications. So it may be difficult for the fund to ensure full compliance. The fund is subject to market risk. The value of these securities, like other market investments, may move up or down. An investment in the fund's shares is subject to investment risk, including the possible loss of the entire amount that you invest. Your shares at any point in time may be worth less than your original investment. The success of the fund's investment program may be affected by general economic and market conditions, such as interest rates, availability of credit, inflation rates, and national and international political circumstances. The fund may invest in securities or financial instruments that exhibit more volatility than the market as a whole. Such exposures could cause the fund's net asset value to experience significant increases or declines in value over short periods of time. Price movements of options contracts are influenced by, among other things, interest rates, changing supply and demand relationships. The prices of commodities contracts and all derivative instruments, including options, can be highly volatile. The fund affects its transactions are over-the-counter or inter-dealer markets. The participants in these markets are not subject to credit evaluation and regulatory oversight, as are members of exchange-based markets. There is no central place or exchange for shares or interests in some of the fund's investments to trade, creating difficulties in evaluation. Some obligations issued or guaranteed by US government agencies are supported by the discretionary authority of the US government to purchase certain obligations of the federal agency, and it is possible that these issuers will not have the funds to meet their payment obligations in the future. The value of the fund shares will fluctuate with changes in the value of the equity securities in which it invests, including investors' perceptions of the financial condition of an issuer. The fund's investment in dividend-paying securities could cause the fund to underperform similar funds that invest without consideration of an issuer's track record of paying dividends. The fund invests in the securities of large capitalization companies, and their performance tends to trail the overall market during different market cycles. A significant percentage of its assets in a sector, an adverse economic, business, or political development may affect the value of the fund's investments more than if the fund were more broadly diversified. The fund intends to trade flexible exchange options, which give investors the ability to customize key contract terms like exercise prices. The fund's counterparty is the OC rather than a bank or broker, and in the event a clearing member defaults, the fund could experience significant losses. The Felix options prices may be highly volatile and may fluctuate substantially during a short period of time, creating a risk of mispricing or improper valuation of the fund's MA. The fund's returns are subject to the effects of compounding, which generally will cause the fund's performance to not correlate to the performance of the reference index. A number of factors may affect the fund's ability to achieve a high degree of correlation between the fund's reference stock basket and the reference index, including the difference in returns between the reference stock basket and the reference index due to compounding. The use of options involves investment strategies and risks different from those associated with ordinary portfolio securities transactions. There may be times the fund needs to sell securities in order to settle an option position, which could result in the distribution of premium from that option position being classified as a return of capital. The writer of a covered call option foregoes any profit from increases in the market value of the underlying security above the sum of the premium and the strike price of the call, but retains the risk of loss if the underlying security declines in value. The fund will purchase a long-dated option on the reference index at the beginning of each designated period as a hedge against long-term decline in the market value of the securities in the reference stock basket. The hedge will not mitigate all loss even if the hedge operated as intended. If one or more of the individual option positions that comprise a box spread are modified or closed separately prior to the option contract's expiration, then the box spread may no longer effectively eliminate risk tied to underlying reference assets price movement. The fund has an investment strategy that may frequently involve buying and selling portfolio securities. High portfolio turnover may result in the fund paying higher levels of transaction costs and may generate greater tax liabilities for shareholders. The fund's strategy seeks to provide investors with a target net income of approximately 9% on an annual basis. However, the fund's distributions may exceed the fund's income and gains for the fund's taxable year, and distributions may consist of return of capital. There may be occasions when a vote is missed by firm personnel. In the event a vote is missed by firm personnel for any reason, that vote will be automatically cast in accordance with the ISS guidelines. The report then goes on to include their voting policies and how things will be voted. Now, looking at these results more broadly, FT Vest seems like a high risk, high reward kind of investment. The 9% income target is definitely attractive, but you need to be aware of the various potential downsides. Given the heavy reliance on derivatives and the fund's overall complexity, it would require a high degree of investor education to be something that can be safely sold. Alright, that's our breakdown of FT Vest Annual Hedged Equity Income Fund 2's initial registration statement. What's your take on these numbers and this strategy? Is this a calculated risk worth taking, or are there too many potential pitfalls? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord server linked in the description for more conversations about these types of companies. Thanks for watching, and we'll see you next time.